Learning a trading strategy from a dancer may sound a little crazy, but if it is the Darvas Box trading strategy that was made famous by Nicolas Darvas, it would not be too crazy. And it's reported that Darvas, using his box method while traveling the world dancing, turned about 36 grand into over $2 million in 18 months trading the stock market. So how did he, while dancing on stages around the world, manage to amass this kind of fortune? Well, as the name implies, Darvas used boxes that were drawn around price, and he would trade the breakouts of the boxes in the direction of the trend. That's a high-level view, as there's more to it, but in a nutshell, that was the technique that he had used. At Netpicks, we believe in a systematic way of approaching the markets, and the Darvas Box method may be something of interest to those that are new to the world of systematic trading. Now, the foundation for the strategy started when Darvas, using only price action and volume, started to buy stocks in a company called M&M Woodworking. But what he didn't know was that the increase in price was happening because of merger rumors that were circulating around. But it didn't matter because the price and the volume was all that he was using to buy the stock. And in the end, he sold out 2 points before the high and before the merger was announced. He just bought an upward moving stock using his box theory, trading with the trend of the stock, which is trend following. So latching onto his last success, he bought into another fast moving stock that was climbing in price. But this time it turned out that simply buying something that's moving up was not a great play, and he lost $2,000. And it was a loss that was concerning for him because it was the best performing stock at the time. Price reversed back to the upside soon after he took the loss, which I think we all can relate to. And it turns out he bought the top of the stock. Well, Darvas dove into hundreds of stock charts and he learned about the movement of price in each stock, and in doing so, patterns began to emerge. He found that stocks, once in motion, tend to stay in motion, and they do so in a series of frames. Price can bounce between the high and low here, breaks out, moves up, same thing here, breaks up to here. When it keeps breaking up, it's a trading opportunity, but when it breaks below, disregard the stock. And it seems simple, and it's not much different than the resistant level breakouts that some traders use today. But just like today, trading breakouts without some type of volatility measure usually does not end too well. As well, you want to see some type of increasing activity before the breakout and not just buy on the expectations of a breakout. Well, Darvas bought an aviation stock thinking it was about to break the high of one box and lead into another one. So he bought it, the stock turned around and wiped out the profits from the previous 3 trades, which was $2,400. So from these experiences, he laid out some objectives in approaching the markets. And this is not much different than Netpicks, reminding traders over and over again to have a trading plan before you enter the market with any trading strategy. The right stocks, the right timing, small losses, big winners. And to achieve these goals, Darvas wrote out what he would use to achieve this plan. Price and volume, his box theory, automatic buy stop orders, automatic stop loss orders. So the trading strategy for the box would look like this. Trade breakouts from the box in the direction of the trend. Trail the stop loss, which will protect open profits as price trends higher. Buy more as the trend continues to move up. Take your profits, cut the losses when the trend reverses. Now, this does not include the stock selection process or what type of volatility measure to use to give you the odds that the breakout has a higher probability of working out. Most often in the stock market, volume could be used, but you're going to have to determine the type of volume that you need to see. And you may want to test such things as an increase in volume that exceeds the 20-period moving average of the previous day's volumes. So number 1, when a stock fails to make a new high for 3 days, the most recent high that is higher than the 3 subsequent highs becomes the box top. Number 2, when a stock fails to make new lows after 3 days, the most recent low that is lower than the 3 subsequent lows becomes the box bottom. We are using the low that forms after the high is formed. Once the bottom breaks in an uptrend, the stock would be taken off the list until a new box forms. So a breakout of the top would indicate a trading opportunity. And here's a recent example of the stock Johnson & Johnson. And number one, this box is well formed, but price dips to the downside and a gap up and over the top of the box. Now you're going to need to rule base what to do when gaps happen. At number two, a new box forms and the green arrow points to the breakout of the stock above the box. The trade is held for 24 days, ends with a break below the box for a 2.5% gain or $125 profit per share. There's a losing trade. Using a buy stop order at the break of the box, the trade's entered. Well, in the current trade, a new box forms following the 3-day high, 3-day low rule. You're still in the trade. Price breaks the box low and exits at the next candlestick open for a 2.7% loss or $135 per share. Now, keep in mind that these breakouts are not backed up by a volume study. The results could be different if there was a measurement made of the strength of the breakout. So I thought it'd be interesting to take a look at a few stocks where the Darvas box strategy is starting to set up. This is the ticker TPIV and the ticker ICPT. So if you're listening to this and you're thinking that this is a breakout strategy, you're correct. But the difference between the Darvas box and the way the majority trade breakouts is there are rules in regards to how the box forms. Darvas will look for highs in prices, and whether that was a 52-week high, a 100-day high, or all-time highs, it didn't really say in the book. He would also scan for stocks that were primed for growth, which back in his day could have been a wide variety of stocks. He would also consider volume to assist in determining if a breakout could be sustained. So can this be a valid approach in other markets, or without the added criteria of volume and instrument selection? Well, there's no question that this is a trend-following strategy that's going to get chopped up in a consolidated environment. And maybe that's why he used a 3-day buffer. Breakout trading is a good strategy when it's combined with other criteria and the ability to cut your losses when their breakouts fail. This is a basic backtest of stocks of the S&P 100 that spans back 6,700 bars of data. It looks promising, and this is without stock selection, volume measurement, tested stops, profit taking, entries, and it could perform better without over-optimizing the backtest. In the end, it's up to every trader to test any strategy that they're interested in. The Darvas box strategy goes back decades, but the key idea is that it is a strategy that's complete with trading rules, including where and when to enter. And when we design our trading systems, we make certain that every system is tested historically on both sample data, out of sample data, and going forward. We want to make sure that it's easy on traders, so everything that's related to the trade, stops, targets, entries, trailing stops, they're all plotted right on the chart, so there's no guesswork. And complete training on every aspect of the system so that every trader knows exactly what to do and when. Now, there are unanswered questions with the Darvas strategy, including which highs to use. And you're going to have to determine what the best measure of increased strength is to allow for a higher probability breakout trade. Breaking a trading strategy down, it's a really good learning tool for developing traders. In the end, it could be too much work. Plus, you need to learn how to properly test it without over-optimizing. And if you find that to be the case, reach out to us at support@netpicks.com and let us help.